It drives me crazy watching people throw money into individual stocks or crypto, totally ignoring the 22. Every month you delay paying off that 22% interest is a month where your net worth drops, regardless of what your stock portfolio did. Building wealth requires treating your capital like an exact science. There's an objective mathematical order of operations for where every dollar should go, and in what sequence. When you skip the foundational steps and jump straight to the fun stuff, like a taxable brokerage account, you guarantee a massive loss of your potential wealth to interest payments and the IRS. Think of your income as a financial waterfall. Your capital must fill the top priority tier before spilling over. That first tier is your emergency fund, simply banking $1,000 to $2,000. Once that bucket hits the target, it stops and flow moves on. Yes, cash loses a little purchasing power to inflation, but Vanguard data shows holding a $2,000 buffer creates a 21% boost in financial well-being. More importantly, it acts as a psychological safety net. When your car breaks down, you use the cash instead of swiping a credit card and triggering that 22% negative compounding loop we just looked at. Once that safety net is secure, the waterfall hits the next step, capturing your employer's 401k match. The math is undeniable. A dollar-for-dollar match on your contributions is a guaranteed 100% immediate return on your investment. Even a 50-cent match is a 50% return. These first two steps are your financial triage. They lock in your baseline security and capture the only truly free money the market offers, before you move on to attacking the systemic drains on your wealth. Now that the floor is set, every extra dollar flows into stage 3. Aggressively eliminating any debt that charges you more than about 8% annual interest. To clear this out efficiently, use the avalanche method. List your debts, pay the minimums on all of them, and then hurl every remaining cent at the balance with the mathematically highest interest rate. This saves you the most capital over time. Every dollar you use to pay down a 22% credit card yields a guaranteed tax-free 22% return. In terms of pure ROI, debt repayment is one of the highest performing investments you can make. You won't find a Wall Street asset manager who can promise a guaranteed 22% return. Even Warren Buffett's long-term average hovers around 20%. Paying off your credit card beats the greatest investor of all time. Until all of that high-interest debt is gone, putting extra cash into the stock market means you are mathematically moving backward. With high-interest debt cleared, your capital cascades into the tax optimization zone. The biggest threats to your compounding now are high management fees and the IRS. You should max out an individual retirement account before putting any unmatched money into your corporate 401k. Corporate plans usually trap you in expensive mutual funds with high fees. An IRA gives you the control to buy low-cost index funds that charge practically nothing, saving you tens of thousands of dollars over a few decades. This quadrant chart maps options based on fee control and tax timing. Pay taxes now or later. Traditional accounts deduct contributions today, great for high earners. Roth accounts take the tax hit up front, but investments grow and withdraw tax-free, ideal for younger workers. Beyond standard accounts, the HSA is the most powerful tax vehicle in existence. It covers both sides of the timeline, providing a tax deduction going in, tax-free growth, and tax-free withdrawals for medical expenses. It's the only account with a triple tax advantage. Maxing out your IRA, your HSA, and then returning to finish maxing out your 401k effectively builds an impenetrable fortress around your wealth, eliminating government taxes and management fees from dragging down your compounding. Finally, once all those tax-advantaged buckets are overflowing, your capital reaches the last step, the taxable brokerage account. This is the standard stock-picking environment everyone usually wants to start with. This 30-year compounding graph illustrates the danger of putting your money here too early. Investing $10,000 annually at 7% in a tax-advantaged account pushes you near $944,000. Do the exact same thing in a taxable account, where capital gains and dividend taxes drag on your growth, and you end up closer to $700,000. You lose nearly $250,000 just by using the wrong account. Taxable accounts do have a crucial purpose. Because they don't have contribution limits or age restrictions for withdrawals, they provide ultimate flexibility. Once your retirement foundations are solid, this account becomes your bridge funding for retiring early or making massive purchases. The entire optimal order of operations boils down to this 6-step checklist. Starter emergency fund, max your employer match, Kill debt over 8%. Max out your IRA and HSA. Max out your 401k. And finally, fund your taxable brokerage. Look at your current reality and find where you are on this list. If you are holding credit card balances, you must hyper-fixate on step 3. If you're a high earner with zero consumer debt, your job is to saturate step 4 before you even think about day trading. True wealth generation requires discipline. When you trade the immediate excitement of picking random stocks for the mathematically guaranteed efficiency of this exact sequence, you secure a financial future that actually works. If you pour water into a metal bucket with massive holes in the bottom, you wouldn't stand there wondering why you aren't making progress. Yet, this is exactly what happens when people throw money at the stock market while carrying credit card debt. That debt sits there charging 22% interest, draining your accounts faster than any investment can fill them. Right now, 1 in 3 Americans doesn't even have an emergency fund. The median amount saved for unexpected expenses is just $500. Down from $600 a year ago. That is less than most monthly car payments. And yet, many of these same people are focused on picking individual stocks or investing in cryptocurrency. It is like buying a Ferrari when you can't afford to fix the transmission in your daily driver. There is a mathematically optimal order for investing your money. It is a specific 7-step sequence designed to tell you exactly where every single future dollar you earn should go. Following it can save you tens of thousands of dollars over your lifetime and safely accelerate your path to financial independence. To execute this sequence, you need 3 pieces of information. First, write down a list of all your current debts and their interest rates. Second, pull up your employer benefits packet. And third, calculate a rough estimate of your bare-bones monthly living expenses. People often ignore this sequence because doing the foundational work feels boring compared to buying the next hot stock. But skipping straight to the fun stuff leaves you exposed to massive financial leakage and long-term risk. We have to plug the holes in the bucket first. This wealth pyramid illustrates the sequence, and it starts right here. Step 1, the emergency fund. This creates a psychological safety net. When a car breaks down or a medical bill arrives, you won't be forced to sell your investments at a loss or rack up high-interest debt just to survive. The traditional advice to save 3 to 6 months of expenses is overwhelming, so we break it down. Start by saving your first $1,000. That covers most minor emergencies. Once you have that, push toward 1 month of living expenses. After you hit that milestone, keep building until you reach a 3-month buffer. Recent research from Vanguard revealed that people with at least $2,000 in emergency savings had financial well-being scores 21% higher than those without one. That $2,000 mark provides the largest psychological boost linked to any financial factor they measured. Once that buffer is in place, basic financial logic dictates that you should immediately aggressively pay down high-interest debt. But the math reveals one major exception to that rule. Step 2 is capturing your employer match. This is the only investment vehicle you should fund before eliminating your debt. If your employer matches your retirement contributions, that is essentially a guaranteed 50 to 100% immediate return on your investment, depending on the plan. Even if you are paying 22% interest on a credit card, capturing a guaranteed 100% return makes mathematical sense. Just be sure to check your company's vesting schedule to understand how long you have to stay employed there to actually keep that free money. Once you are contributing just enough to get the full employer match, you redirect every remaining dollar to step 3, the debt avalanche. This targets any debt charging you more than about 8%. Carrying credit card debt while trying to invest guarantees your net worth gets pulled downward. Paying down that 22% debt yields a guaranteed 22% return on your money. Securing these first 3 steps repairs the foundation. You have stopped fighting a mathematically losing battle against banking fees, secured a safety net, and locked in guaranteed positive returns from your employer. With the foundation stable, we enter the tax optimization zone. Step 4 is maximizing your individual retirement account, or IRA, up to the $7,000 limit for 2025. You fund an IRA before putting additional money into your employer's 401k, because IRAs give you total control over your investments. Instead of being restricted to a limited menu of expensive mutual funds with 1 to 2, to use this account, you are required to have a high-deductible health plan. If you are young, healthy, and meet that requirement, the HSA is incredibly powerful. It is the only account in America that offers a triple tax advantage. You get a tax deduction when the money goes in, the money grows tax-free while invested, and any withdrawals used for qualified medical expenses come out entirely tax-free. Because there is no time limit on when you can reimburse yourself, the optimal strategy is to pay your current medical expenses out of pocket if you can afford it. Keep the receipts, leave your HSA funds invested in the market, and reimburse yourself completely tax-free decades later. Maximizing the IRA and the HSA functions as a legal shield. By legally removing the IRS from the equation, you keep 100% of your gains, allowing compound growth to accelerate without annual tax drag. Step 6 requires you to log back into your HR portal. Now that your IRA and HSA are fully funded, redirect your remaining cash flow to max out your employer 401k up to the $23,500 limit. Reaching this level means you are sheltering over $35,000 of your income from taxes every single year. Achieving this places you securely in the top 5% of American savers. Only after those 6 buckets have full do you reach Step 7, taxable accounts. This is the Wild West, where you have unlimited contributions and total freedom to buy individual stocks. This bar chart shows why this step comes last. If you invest $10,000 annually for 30 years at a 7% return in a tax-advantaged account, you finish with roughly $944,000. In a taxable account, paying annual taxes on dividends and capital gains, you finish with closer to $700,000. That is nearly $250,000 lost entirely to tax drag. The actual purpose of a taxable account is flexibility. If you want to buy a house in 5 years, or you need bridge funding to retire early before you can legally access your 401k, this account gives you liquid capital without withdrawal penalties. That flexibility is highly valuable, but only after you have saturated every available tax-advantaged vehicle from the previous steps. Look at the completed structure. Every single step relies on the integrity of the block beneath it. You cannot maximize a 401k without the cash flow freed up by eliminating credit card debt. You shouldn't invest in a taxable account without the safety net of an emergency fund. By executing this sequence in order, you neutralize high-interest banking fees, capture the free employer capital, and legally circumvent the IRS to maximize your compounding power. Your next move is to log into your employer portal today. Verify your exact 401k match, check if you are eligible for an HSA, and then locate exactly where you are on this pyramid. Do not move up to the next level until the level below you is fully secure. Following this disciplined step-by-step sequence isn't nearly as exciting as trying to pick the next hot tech stock, but doing the boring work first is exactly what yields the massive, resilient wealth that most people only dream of building.